All right, Josh, go for it, man.
The beard is looking nice, Nick. Looking nice. Now, look at that. Yeah, impressive, bro. Hey, are you looking to add any time soon to Frank Yen?
Yeah, I am potentially maybe looking to add. So I can walk you through it if you like.
Go for it. That'd be great.
All right, so just for context, most of you know, but just for those of you who don't, I'm still short on CHFJPY. Price floats currently around my entries. Um, from where it was at when I opened it this morning and posted a little bit ago in the Nick's Trades group, it's about 1/8 of the way to the stop loss. So it's $80,000 risk. It's 1/8 of the way there. So I put this right here. I might maybe potentially look to add to the position if she starts dropping today. Here's how that might look. I'll put a caveat in here and say nothing is set in stone. I think it's important to be very fluid and flexible with your decision making and not get tied down into some sort of predetermined bias or predetermined plan. I just don't think that's the best way of accounting for the context, especially in something like trading. But as an example, and if price, let's say it knocks out this low right here, and then it starts trying to go up again, and then it fails and starts to make a lower high right here, then it starts to go into more profit. My position average currently sits about right here. I've got positions down here, and then I've got more positions that I've added throughout here a little bit higher as price started to continue going. So the position average sits somewhere in the middle of all of these. I've got a total of about 20 standard lots here on this trade. So if price could start moving into a profit and start breaking these recent lows, then whether it's today or later this week or something, this would provide a decent opportunity to add because now since lower highs would be getting created, it would be a way to say if price does start making lower highs and going down from here, it would be a way of saying, okay, I'm going to get in now adding very heavy with the understanding that if price starts breaking out of this lower high structure and going up, I will have to liquidate a portion of my position to control risk. Because if it starts breaking out these through these highs, it would one of two things would likely happen. Number one, it would just continue going into drawdown. The increased risk would be reflective on your P&L as it goes up, and then that's just not exactly what I would want. The second thing is that if it invalidates and starts going up higher, the likelihood of that outcome, like playing out of it going down, would become less likely. Therefore, I would want to take some of my position off the trade, still thinking that it will drop at some point, but without wanting the potential likelihood of sitting in, let's say, a trade that has a $100,000 risk as it goes into $50,000 of drawdown, and then having to ask myself the question if it gets up here to 180, do I add here like I originally planned? When I've already essentially gone in like $100,000 risk at that point if I do add. So there's a couple things that would be the case. If it could start doing something like this, Josh, like just a break of the low, that could be a position I'd add with a very tight inval for, let's say, a third to half of my positions just above one of the recent highs or this high. If it breaks the low, then tugs back and then starts looking like it's going to make a lower high and then go down, that would be good. And these are generally less risky because you've already had the pullback, you've already had a little bit of the failure and it starts going down. The only thing is, whenever you're adding like this or even starting positions like this with relatively tight invalidations, the likelihood that that invalidation is going to get hit is significantly higher than if it's, for example, like my trade, like where it's way up here. Like the likelihood it's going to go all the way up there in one go without having any sort of like pullback where I can get out and profit or break even or something like that. It's very unlikely. And you know this, Josh, of all people. But given
Mm.
the totality of the circumstances and the really precarious prices we're at right now, I think at any moment this could drop, and I would like to get in while assuming a little bit of additional risk if it does in fact start to go down. One thing I also toyed with the idea of last night, and then my explanation will be finished, is I toyed with the idea of if it starts moving down here very aggressively and quickly, let's say a big bear candle knocks out the recent low where it's at right now, then it knocks out these two lows and it just starts going really quick. I actually had an alert here. You could see my creative alert named LOL. I had an alert here if it breaks the lows quickly that I might just add another position here and it wouldn't be heavy. I'm in 20 standard lots. I might add another, let's say 5 lots to it. But what I might do at that point is then drag the invalidations for all of these positions up here from where they're at, way high at like $80,000 risk. I might just drag them above these highs because then that would be reflective of about a $20,000 risk. And while the likelihood of it hitting that invalidation is much higher, there would be multiple things I could do in the trade management dynamics that could get me out before that's hit. And even if it is hit, the potential for profit remains 60 to $100,000, while the potential for loss at that point, if this happens and if I do that, would only be capped at 20K. It's just kind of parsing the likelihood of whether or not it's a high probability of ending in profit versus loss. And me waiting for the appropriate price action before making a trade decision like that to add is really what will kind of be the determining factor as to whether or not this outcome ends in profit or break even or loss. So that is a bit of my thoughts as to what situations I might add under. What do you think?
Yeah, it's well explained. It's similar. I was looking to add. I'm back in Frank Yen as well today. So yeah, I'm waiting for it to break or retest that big wick down around the 177.90. I say 178 area. Kind of, yeah, kind of about there, yeah, 178 to see what happens around there. And I'll look to add if it breaks that and retests. My
Yeah.
idea anyway.
What type of position size are you in total right now?
I've gone in with 10 lots at 178.70.
Okay, cool. That's a pretty good price. Yeah, so your risk is roughly if your invalidation is somewhere near mine, your risk is like maybe 30 to $35,000 with where it's at.
I've
Um,
got my inval at 181. Yeah, so it's about 26 or something.
okay, cool. Yeah. So about a little under 30K. Yeah, that gives
Yeah.
you plenty of room to add to it and plenty of room to take additional risk. Yeah, it could be a pretty good trade. This the reason I've still held this instead of trying to play the short term game and get out and get back in and then wait for 180 and wait for it to come back down. Reason I've held this for a week is just because I know that at any moment this thing could drop, right? It could barely take out the highs today. It could go sideways, it could go down and then up and range for another week and then go. I've recognized this exact same sort of situation just endless amounts of times. It's got to have been hundreds of times throughout my trading career, where price was going up really far in one direction, makes a higher high within an uptrend, and then just falls really quickly. The most recent examples of these was USD MXN. At any moment, this could have fallen, right? So we got short up in here,
Yeah.
added to my position up here. Any moment it could have fallen, and you never know when. Like even if it looks like okay, it's pulled back, it's about to go up and make a higher high, pulled down here, went up, went sideways for a bit, and then out of nowhere it drops, right? Now I was out of my position here and like a small, like a 4K profit, right? So it started up here, added up here, it came down, everything was in a little bit of profit. I closed it. This ended up working out, but this just characterizes the fact that you never know when it will be if this is the context in which a person is trading. If you're entering, betting on the fact that at some point soon it's probably going to go one direction over the other. In this case, it's going to fall. It's really hard to time that, which is why I use such big invalidations because I know that some point soon I think it'll drop, but I just don't know when. It's even scarier when you have shit like this GBP CAD, I got short up here. Started going, I added to these. When it broke up here, I closed at a small loss. I started the position again up here, second time in the next trades group. And then I closed around break even. I think it was a small loss. It was like a 2K loss, 1K loss, 2K loss. It's all in there. So I closed here. Then it went up higher. And then like this, if this is exactly what CHF JPY is doing right now, right? We're making little tiny inching upwards, higher highs and higher lows. And then all of a sudden, out of nowhere, right? It pulls back, starts to kind of pause. You think it might be going to make a higher high, but then just out of nowhere, that happens. Now, I was fortunate enough to catch the most of the bigger chunk of this move right here, but it's not what my original profit would have been had I just held. I'm not regretting my decision to close here. It did, in fact, just go sideways for an entire fucking week before having another move down. But this move alone was $18,000 profit. So it made back all the little two losses here plus a significant amount of profit. But this just goes to show like the big idea of it moving and making a higher high and then kind of tugging back here. This did in fact play out. All it did was just require patience. And so that's what I'm doing on CHF I'm betting that this move will play out at some point, even though you don't know when. For this move to come to fruition from when I first started shorting right here around these highs, the 28th of May until it concluded here on June 14th. So we're looking at about almost 3 weeks, two and a half, maybe 3 weeks. So it's one of those things where hold on, it's one of those things where it would be nice to be able to time the position good because like you, Josh, if you're entering towards the top, then it starts going into profit and you start adding aggressively, like just kind of betting that the momentum will continue and maybe you decrease your invalidation to just above the previous high. Maybe some people even move their stops to break even. That increases the likelihood of it pinning you out because now you're betting on timing and not betting on the total outcome. Because like say you have a position here and it starts going into profit, you add down here, then you put a break even stop for this first position. It's annoying sometimes because price might have another little tack upwards before it starts collapsing and falling back to the side again. And even though you get the whole move right, a little technical thing in here of you like moving this position to break even and adding there, that would cause you to get thrown out, which is frustrating because then you don't have either a profitable outcome or you don't have as much of a profitable outcome as it could have been had you just let things play out. So adding to trades and fucking with the invalidations and stop losses and putting things to break even, it's very, very tricky. Like it really requires a lot of experience because no two situations are the same, right? No two situations are identical. Every individual situation is different. And if you're being honest, you have to say that like you don't know exactly what would have to happen for you to be able to add to something. Like that's the only real honest answer. The most honest answer you can provide is like it depends. I don't know exactly what I'll do, but I'll know it when I see it. And if I can think it through like in the moment it's occurring, like say it pops down here really quickly and starts to drop with a huge bearish candle. If I say, okay, if I add here, what would happen? You think of it like a chess game 2 to 3 steps ahead. What would happen if I add here? Okay, if I add here and it immediately goes up, how much drawdown will that be back to where it was before I added? How much drawdown will it be if it breaks these highs up here? Um, how much drawdown will it be if it goes to the next spot I wanted to originally add up here, right? And in my case, if I add, this would be like $50,000 of risk. By asking those questions before you hit the buy or sell button, especially when you're adding to a trade, it gives you a sort of like a worst case scenario in terms of risk that you can sort of pre-plan. You can like predefine that risk. And then it gives you kind of a basic feeling for, okay, if I do this and this bad thing happens, what is the likely outcome going to be and what are my actions going to be? Now, this makes it sound like I'm trying to pre-plan everything in advance, which I'm certainly not. All I'm saying is that from a risk perspective, you have to make sure that if price does in fact go into drawdown after you add, you're not going to be doing something, for lack of a better word, stupid. Like you have to rely on the fact that you're still going to be able to make logical, rational, calm decisions, and you're not going to get emotional and start closing shit early whenever it makes zero sense just because you added too heavily and you didn't think through what would happen if it went against you. So the main thing whenever someone's adding to especially to a profitable trade where you're adding at shittier prices as it goes into profit, the best thing you can think of is just to ask yourself, if I do this and it goes against me to X price, what would I do? How much drawdown would that be? Am I okay with that? Should I maybe use a smaller position size? Should I decrease the invalidations for my total position? Should I just maybe not add at all and wait for it to make a lower low and then pull back and then maybe add there? It's asking questions like these that help you make decisions that are less risky in the grand scheme of things as compared to just saying, "Oh, it's in profit, I'm adding there." It's something you have to kind of think through, really paying close attention to the risk structure. But that makes sense to you, I'm sure.
Yeah, it does make sense. I always find adding to the winning positions a little bit more tricky than the losers. That makes sense. Yeah.
Adding to losers is a really underrated practice. I mean, if you've pre-planned it like you have, right? Like you've pre-planned
Yeah.
like you're in about little less than 30K risk right now. There's trades that you have taken, like the AED JPY trade 2 months ago, where you have risked $100,000 on or 90K or whatever it was. So you giving yourself that room to add at a better price, provided you still have the context that you still believe price is likely to revert into profit at any given moment, it allows you to make those kinds of decisions where, you're at 26K risk right now. If you add, even if you just use the same position size, right? You're not actually doubling your risk because if you're adding at better prices, it's a little bit less than double. You may be adding an additional, let's say 30 to 40% of what the total risk was to it. So if you're in, say, 10 lots right now and you add at 180, your risk doesn't automatically go up from 26K to maybe like 50K, right? So it doesn't just
Yeah.
double. It's maybe
Yeah.
only an extra 20K of risk. And then then not only that, but you're adding to a position that is more likely to revert, more likely than ever. This whole thing about like price goes into drawdown, and so adding in drawdown is bad and never do it, and it's horrible. Why would you add to a trade that's not working? It sounds good in theory, but in practice, if you're trading this way, like you and me, where the whole concept of the trading approach is based entirely around and exclusively around the fact that price will have a reversion at some point if it's gone one direction far enough without having any pullbacks. It is one of the worst decisions imaginable to not add in drawdown if you have pre-planned the risk structure and you accept what the final risk could be whenever you do add by using like a final stop loss, final invalidation. So all of this just has to be judged in the context before you enter the trade, especially when it comes to the risk. So it's good that you're doing that.
Mm. Yeah, I guess it'd be a different story if you're trading the lower time frames, right? If you're trying to add and manage and do 15 or 5 or whatever. But yeah, I think hour up's all right.
It does work better, in my opinion, on higher time frames. Just because if you get into a move, say on the 1 minute, it starts going against you. A lot of people, when they hear adding and drawdown, they just think like, okay, it goes against you, so you just add. Then it goes against you more, so you just add. Then it goes against you more, so you just add. This is not what people like you and I are talking about, where we're adding to a losing position, right? Like to phrase it in the way I just phrased it makes you look like an ape throwing your shit at someone. Like it's the way that you and I approach it is way more judiciously and meticulously pre-planned. Like we're like, I enter here, there's a potential plan to add here if it goes up, because you know it could make a higher high before still having the huge reversion to the downside. And you know there's a very high percentage chance that'll occur. And on top of all of that, you still have a final invalidation. You still have a final point at which you'll
Mm.
say, this is not working. This is something that's an anomaly, and I'm going to close here and I'm going to accept the loss. And even when you lose, the average win that you will make when it does work out, a high percentage of the time, as long as it's hitting close to the 1-to-1 risk reward ratio, right? Like it's 0.75 R up to 1 R, because not all trades will work out all the way to the target. Sometimes you close early. as long as you're roughly making more than what you're losing on the losers, generally, it allows you to get out of a lot of losing trades way earlier before the invalidation. You could get out of them at break even or just a partial way to the stop loss. But the winners that go into profit, not only do you profit from them, you profit very heavily from them if you were able to add at better positions and then hold to close to the original target, for all intents and purposes. Like if you risked 40K going into the trade, you added and the trade risk went up to 80K, then it goes into profit. Closing the trade in a total profit of $40,000, like whenever you think it might be likely to kind of pause and stop and you just want to get out of there, that's not a bad idea because the likelihood of that playing out is such significantly higher than it not. But even when you lose, if you're adding in this context, like we're doing, still using stop losses in a final invalidation where we get out, even when you lose, like it takes what, maybe one or two trades to make it back. And if you're winning, like in our case, like 85% of the time or more, it's just a risk structure that makes perfect sense to add and draw down. And that sounds very contrary to a lot of what people believe.
Yeah, well, it's worth it. So
It is working indeed. It just requires a lot of patience, something that I've seen not a lot of people have. However, it can be developed. We've got a Cage. You've got your hand up. What's up?
Can you hear me?
Yeah.
Awesome. So, when you predetermine adding to a losing position, like how you determine the price? Like, what's kind of like the thought process?
I don't understand your question. Let me put your question into my own words. When you're adding to a losing position, how do you determine the price? This is what you're asking?
Yes, like how you plan it, type of deal.
Okay, so how do I plan adding to losing positions? Is this your question?
Yes,
So there's two major things. The first one is asking myself, do I think the initial entry is, quote, good enough to like work out and to likely have the likelihood of being a profitable trade? The actual practical example here is I started this position up here and I had a plan to say, okay, visually on the chart, we're not even looking at the price handles. We're just looking at visually on the chart. I know you're looking on your phone and you're driving, and so I you can just watch the recording of this to get more context later. But for those of you on the call, um, you get to see this. So my thought process is if I'm starting the position here, what could be another likely outcome instead of it just going into profit? What if it goes into the drawdown? How far do I think would be a good spot to maybe start a second position if it does do that? And the way I do this is not numerically, I just visually look at the chart. So when I entered this one, I told myself, well, you know what, if it goes up here to 180, that looks like visually on the chart, in my very humble subjective opinion, that looks like an area where I would be willing to add more at. And if it went a little bit further, all the way up here to 181, that would be a spot that I would look to potentially add at because then I know even if I get it wrong right here, and it goes up a little bit against me, like it in fact has, right? It's gone 1/8 of the way to the final invalidation, almost at 183. It's like at 182.7. So if it goes all the way up there, yes, I'll lose. But if it just goes a little bit against me and price still looks like it will revert, it's judging it by looking at the entire picture and saying we have gone 1,200 pips in one direction with zero pullbacks. All I'm saying is that some point soon, I believe price is likely to have a reversion to the downside. And yes, I'm not always going to be immediately correct. No, almost no trades go immediately into profit, but it's me sort of visually looking at the chart and saying, if this happens, in this case, let's call this X. If X happens, what would the likely outcome be? Well, I still think it'd be likely to go down. So it means I can add there at the better price or at a better price while still maintaining like my final risk structure, which is up here where the stop loss is at like 182.7. What this allows you to do is it allows you to not get nervous whenever things go south. So, oh, in fact, my stop loss is all the fucking way at 183.71. So 100 pips higher than I just showed you on the chart. Very, very extremely safe location to have a invalidation. Like for this to get hit, price would have to immediately go all the way up here in one direction and then hit that with zero pullbacks. Now, the real question here is, since you're wanting, since I'm adding in drawdown and this is how the risk structure works, is the real question is to ask, what is the likelihood of that occurring? A straight move in one direction with zero pullbacks, zero chance to get out at break even, zero probability of anything. What is the likelihood of that right there happening? From my experience, it's extremely low, like single digit percentages low. Um, and with that being the case, that's how I sort of decide on which potential levels to add at. It's also important to say that even though I'll visually look at the chart and ask myself, okay, price could go up to this next zone and then I could potentially add there before going down, it doesn't always mean I'll actually do it. Sometimes, like if price meets a zone and it has, let's say it's like a huge bullish candle that has a lot of bullish pressure and there was a news event that was just released and that's fueling the momentum up, you can bet your ass I'm not going to be adding in something like that. That's like stepping in front of a truck that you're driving right now in the middle of the highway and praying that the truck stops when it's like 20 feet in front of you going 60 miles an hour. You're probably going to die. So I don't like doing shit like that in trading. I like if it's one crazy move like vertical bull candle like that, that's probably not going to be something I add at, right? So it's all contextual. This also highlights something you probably didn't even think about this. This also highlights the fact that there is a lot of very dynamic factors whenever it comes to trading activities that you cannot calculate mathematically. This is why it is so difficult to prove or disprove a manual trading approach, because it is just that. It is not a system and it is not a strategy in a quantifiable black and white absolute sense. It is an approach, sort of saying like, if this happens, then I might do that, but I'm not sure, and it kind of depends on the price action. And there's no way to map onto reality and project exactly what your trading decisions will be in the context of a trade unfolding for the duration that it's playing out. If you're truly trading with experience and you're not trying to follow a black and white system, if you're truly trading from experience, you can never quite predict what every single trading decision will be. So even though you may pre-plan before, like I'm going to give myself some room to add here for CHFJPY at 180, for example. I know what my drawdown will be if it gets there. I'll be in about $30,000 worth of drawdown. If it goes there and then I add, my total risk will go from $80,000 to $100,000 on the trade. I'm okay with that. I've already accepted that. I've already pre-planned that. I'm already okay with whatever outcome occurs. And it's more so just betting on the stats that it will play out. But even then, like if it starts reverting into profit and then I see it looks like it's making a higher low, there's plenty of times I just close my full position on like a small profit or a break even or a small loss, anticipating that with the position size I'm in and then the price action that was painted from the moment I entered the trade to where it's at now on the chart. If it looks like it's no longer as likely to play out and hit the final target, this is purely subjective, then there's often times where I will just elect to just close the trade at a break even or a small profit or a small loss. You will never be able to predict all these things, which is why it's so easy to rip apart a trading approach in hindsight or in foresight, saying like, look, I can prove it doesn't work, or look, I can prove that it would never work. However, what matters is the moment to moment decision making, the exercise of a trader's discretion, their price action discernment, being able to make those decisions in real time. That is where the skill set of trading lies, and that is where all of the edge comes in. There is no other edge in manual trading except a trader's experience to make those types of context-based decisions, such as a thing like you asked, right? Such as like, do I add here? Do I wait? What if it gets there and then it starts to bounce, but then it starts going sideways? Maybe I'll add half of what I would have normally planned to add because it still looks like it's worth a shot to add, but maybe I'm not as confident. So maybe I'll add half of what I intended. Then if it starts to drop, I'll put a break even stop on that first additional position, and then I'll add my second position to it, and I'll just have a quick final inval for both of those. But I'll keep my entire position open at the initial stop loss, right? But all this stuff, it can seem very complicated to somebody that does not have the experience. Whereas whenever you have the experience, your brain starts to notice all of the little nuances and intricate details and things you can do. There's a lot of subtleties involved, and there's a lot of tiny little dynamic moving components. Every single trade is not static. There is no set of decisions that can be objectively quantified in black and white mechanisms that can result in long-term profitability in the context of a manual trading approach, in my opinion. It is a fucking moving target. It requires people to get experience and actually think through, this is where price is at now. This is where my original trade is. This is the dollar amount P&L. This is the drawdown. This is the final invalidation. If I add now and I'm thinking one or two steps ahead, what's going to happen if I add here and it goes against me? By asking questions like those, it allows you to sort of pre-plan that, and it allows you to at least be comfortable with whatever your risk tolerance is while still having sort of predetermined what the actions are. So that way you're not doing things that are irrational whenever a trade begins to unfold and you find yourself sitting in drawdown. So I know this was long-winded. It may sound like word salad. I really tried my best to put things into context and provide the appropriate context and subtext to everything that I've said. That way you guys can frame it properly when approaching trading. So let me know what you think, Cage.
It makes sense. Like if I had to put in my own words, it's, like you said, it's now. I missed the like last 20 seconds of it because my phone froze. But if I understand correctly, it's not really black and white, not staggered. It's kind of like rely on price action and how it's moving at the time. And even though you planned it out, it's like if price doing like some random like you said, just going straight up, you won't follow that plan because it's not as smooth that you want it. So it's not as smart to put your second position in because price is not reacting how you feel comfortable to react for you to add. Is that some similar or am I off the ball, on the ball?
Everything you said is a proper representation of it. I think the simple takeaway everybody can take from everything that you've just said and everything that I've just said and from your original question is whenever it comes to entering any trade and then potentially adding to it, whether it's drawdown or profit, the simple way to approach this is to just do whatever you want. Don't try to go into all of the reasons for or against. Don't try to quantify anything in absolutes. Don't try to do the same exact thing every time. Relinquish the desire to stick to something black and white because it just will not work in every single trading context. Every trading opportunity is significantly different. The decisions will require a lot of nuance and dynamics. So I would say get away from the mental gymnastics of trying to objectify and mechanize everything. And instead, just literally do whatever the fuck you want. Make sure it's a demo account if you're just learning, and then just watch what happens. You'll be able to start noticing things like, I did that, but it ended up going into drawdown. So had I used a smaller position size and accepted that that could happen first, I could have waited for it to go to that next price where I actually thought it would bounce. Then I just could have added there. And then that would have increased my risk by like 30%. Maybe the risk was originally 50K. Now maybe it's 70K, 75K. You can do all this in the pre-planning of just the risk management. You can still define like, okay, I started this position with a 30K risk, but max, I'm going to risk 100K on this. That's the worst case scenario. I will not go above 100K risk. So that's the only real thing you can objectively quantify. Everything else, as far as the speculative reasons why you what will or will not do something in trading, that is all subjective. The best way to learn that is just do whatever the fuck you want. Make sure you're tracking it. Then you can start learning from the experience as time goes forward. So what you said is true. Yes, it all is all truly subjective, and it's all just up to each individual trader to decide what they want to do in the moment. And then over time, you just do more of what seems to work and less of what seems to not work.
Okay, that makes sense.
Good stuff, man. It's a good question. We've got 90 people on the session now, so welcome everybody who joined. If you'd like to chat with me or you have a question, just click the Zoom option to raise your hand and I'll call on you. And then we can have a little chat about whatever it is you'd like help with. Chaba, you are up next, my friend.
Hi there, Nick. May I draw on this screen to illustrate my question?
Yes.
Thank you. So I noticed the most trades that you've taken, just looking back, is going up in an uptrend. It makes a significant higher high or a significant lower low, and then you just enter. However, I've my question is that is it um, why is it different if it was a trend reversal? So we're going up and then we started coming down again. And then this is the new trend. Uh, you would, in my opinion, wait for this low to go before entering a long position from here. And my question is, why do you do that? Because there are quite significant lows that get taken here as well. And there are some quite significant lows that get taken there too. So my question really is why is this more significant than these, basically?
Yeah, it's a good question.
Relate to it.
So this is akin to asking like a hunter, hey, you had all those opportunities to shoot that deer, but you waited on every single one of them until the last one. And then for that, for some reason, you pulled the trigger, you got a perfect shot, and everything worked out. Um, and the reason it's like this, is it a perfect example? Probably not, but it illustrates the point, which is that just because it might be a, say, okay idea to just buy if it breaks one of the recent lows, and then it could go to the next one and breaks that one, maybe buy. You've pointed out that I'll wait for extremes before entering. And the reason I do that is for the same reason a hunter only pulls the trigger when the conditions are perfect. A hunter does not want to injure the animal needlessly. A hunter doesn't want to shoot an animal when it's moving. A hunter doesn't want to risk hitting it in the neck and the animal suffocates to death. They want it to be a quick and easy kill. They want things to work out as efficiently and smoothly as possible. I find that even though the opportunities that you sort of illustrated, like what if it breaks a recent low, you could still take it. Even those still might be, let's say, decent or quote, okay trading opportunities. I find that it just works so much easier and so much more predictable and so much more efficiently and effectively if I wait for what we will call, quote, extremes. When I wait for that, almost every outcome I will be correct on, and almost every outcome I will profit from. And the hardest part of this whole trading approach is just patiently waiting for that to occur. I'll put the caveat in here by saying that there are many, many, many trades that I miss that might have resulted in a small amount of profit, that might have resulted in this and that. The problem is that I am very concerned with what the likelihood of price hitting the stop loss is. And whenever you enter something like this, like you showed, whenever price, let's say it was stepping up, and you're like, Nick, you're quick to take a higher high. So let's say it goes and breaks that low. Why wouldn't you buy there? Or let's make it more realistic, right? It goes down even further and it breaks that low. Why wouldn't you buy there? Say there's a major low there. There's all these potential lows you could buy at. Why would I wait for this to happen first? Like a break of something major or just something more significant. This is generally a higher time frame low, right? Maybe on the 4 hour daily chart. Sure, there are all these opportunities here, and it sounds fine in theory to say, well, it broke one of the recent lows. Why not take a buy? I mean, it is what it is, right? I just find that in practice and the actual execution of my trading actions and decisions, it works so much easier and it's so much more worthwhile to only wait for significant big lows or significant big highs to break. Because I know, not only from experience, but from objective statistics over the past few months of just doing this and nothing else, I know that a couple things are the case whenever this happens. The first of which being price has generally gone in one direction for an extended period of time with no significant pullbacks. On top of that, if you take out a major structure level, it has a much more significant effect for a potential reversal as compared to something like this where it just broke, one of the recent lows and now you think it might reverse. Well, if you think it might reverse, well, how much? You think it's going to come all the way back to the previous low and break your retest? You think it's going to go and break the high? What if it goes all the way up to the previous high? Where the fuck do you put your stop loss? Where do you put your profit target? How far do you think it'll go? Something like this is very difficult to not only control risk for, because you'd be entering here and you could have a stop below that low, but then you're like, well, it could break that. Then it might bounce at this low. So then you have your stop below there. But then you're like, wait, if it goes all the way below that, that's the most likely area it could reverse, which is a huge new low. So then where the fuck does your stop go? If you put your stop up here, anywhere close to current market price, you end up getting stopped out more frequently as compared to if you were to do this, which is saying, we'll say this is a 4 hour or daily time frame, right? You end up getting stopped out less frequently if you do something like, I have to give us some room here, like selling here with a stop loss up here, and then a take profit down here. And the reason is because structurally on the chart, like visually, we know, I mean, it takes anyone just going back on a chart on some sort of a higher time frame. We'll say 4 hour daily just to be safe. Sure, it might work on others, but 4 hour daily just to be safe. It takes quite a bit of, call it volume, momentum, liquidity, whatever you want, for price to go this far in one direction with no pullback and then to continue significantly higher, right? You increase your odds of winning if you just distance the stop even further, and that also means increasing the profit target. But the same sort of rule of thumb applies, is that the further it goes in one direction, especially after it has sort of this nice clean pattern of higher highs and higher lows, there is a lot of people who have bought this trend here and it happens to go up that time and then nothing, it didn't go further and then revert. It didn't go all the way down here to the low and then revert. It didn't break the low and then revert. It didn't go all the way and break a major low and then revert. If they get this move right and it goes all the way up to here, a lot of people are taking profit as it makes these higher highs. And then as it makes a higher high and then starts to quickly drop, you have a lot more people not only taking profits, but actually entering short positions as well, which causes a further surge in price decline because nobody's buying and everybody who is in buys, a lot of them are closing their buy positions. Waiting for something like this, the stats, the efficiency, the effectiveness, the likelihood of it playing out, they are all so much higher as compared to the sort of thing you described where it's going up and up and up and down, something like that, and then it goes and it breaks a previous low. If it breaks a previous low, but the context is not that it's in the big picture of things and it's not like a grand triumphant push past a major low or a major high, I have just found that from a subjective perspective, this just works out way less of the time on a percentage basis. But on top of that, it becomes exponentially more difficult to control risk because then you have to accept a higher likelihood of a stop getting hit. Because if you put it just below here, it's very likely to get hit. If you put it below that low, it could get hit just to like revert right after. And then if you put it like say below that low, like you're putting your stop so far from your entry up here all the way down here, and you're putting it at a location where it could immediately revert right there because it's gone so far and it's just begging to tug back at some point. So I hope that all of this illustrates as to why I generally wait for situations like these, which is extensions past major previous highs or lows, instead of waiting for breaks past what a lot of us would call more recent, kind of less significant highs or lows. It is because the higher likelihood of this playing out is extremely higher. And also, it's way better to plan from a risk structure because, if your stop's up here and your target's down here, your stop is unlikely to get hit and your target is very likely to get hit. So let me know what your thoughts are and feel free to ask any more questions about this.
That's really well explained. Thank you. So is that why, for example, on Bitcoin, you wouldn't enter just yet. But until it broke that low or major low on the 1st of May, maybe you would wait for on the 4 hour. So talking about that low. Sorry.
So in general, yes. In general, there's a bit more writing in between the lines here though, which is that this is not a trade, right? This is a long-term position. So whether or not this breaks the low or goes up from here, whatever, like I'm still holding a lot of the tokens, right? This is not a trade. This is a long-term investment, or if you'll call it that. It's a long-term hold. So you probably had a lot of people buying this pullback here. You've probably had more people buy as it dips even further here. You probably had a lot of people buy like at this support, right? I don't have the zones on my chart right now, but that's a little support zone where there's lows. And you probably have more people waiting to buy at this low down here. In my opinion, there's going to be a lot of people that have invalidations or stop orders underneath that low. And if you believe that something overall is likely to move in this scenario up, I find that waiting for something like that, like one of those lows to break and buying down in here, for one, I mean, it would have had to have gone like 40%. So in this case, 30% into the negative, like from its highs. That's a big move in one direction without any real major pullbacks, right? That's with it. That's if it quickly goes somewhere down here, say 52, 50, $50,000. That it'll go in one direction without a major pullback. But on top of that, there's a lot of people that would have immediately gotten like stopped out of a trade like this. Now, I don't know if there's some sort of truth to the conspiracy that like when everybody gets their stop hit or price breaks a low or a high, it's more likely to go in one direction or the other. I don't know. All I'm saying is that from my experience and my subjectivity, adding right now, I posted yesterday, I might add here at these lows. Adding right now, especially with this big bearish candle here, sure, this could go up. And if it does, it's fine. I already have a lot of crypto, but I would much prefer to wait for something like that because it's a way better price and it's way more likely to revert because we've just taken out like a major low that Bitcoin has refused to break since like, so this has been March of this year, right? So we're 3, 4 months into this. Bitcoin is held above here. If we knock that out, provided that I still think this is overall likely to go up, I'm more than happy to add there. And I'll probably add even more than 100K. Then if it goes back up to the highs, that'll be like a 25%, 30, 35%, about a 35% move up. So that would be a more likely thing to play. It is roughly the same sort of thing as you've already seen, as if price were to be going up and down and up and down, up and down. And then I'm selling up here like very high, anticipating that. I don't know exactly when it will drop. Maybe it drops from here. Maybe it goes a little bit against me and then drops, and I'm able to maybe add a subsequent position at a pre-specified price if it goes further up. These type of outcomes are more likely to play out, which is why I wait for them. So that is why I guess a portion of the reason I haven't added to Bitcoin right now, and it just quote unquote feels kind of weird, is because it's at a location where like I don't feel it would be the best idea to buy. I think a nice, clean, quick break below the recent lows would be such a good price to add at. So much better, so much more likely to reverse. And then if it does reverse, oh my God, you make so much more profit. Instead of adding up in here, it's 14% to the previous highs. If you add down here, it's over double the profit. And all you have to do is fucking wait. So that's why I haven't added to Bitcoin yet. That's what I might do on Bitcoin. And this is also further context to why I do what I do, just in FX trading in general. Does that make sense, or is that helpful?
Yes, thank you.
Really good questions from you over the past week, Chaba. Really good questions.
Really good answers. Cheers.
Yeah, and tell me something. Give me a bit more feedback. I feel like I oftentimes go on way too fucking long, but the only caveat is that I don't want to give sort of a non-useful, quick, oversimplified response. I want to make sure all the context there, which is why I try to take the time to do it. Do you think that's appropriate, or do you think I just kind of ramble on for too long?
Well, I think everybody has a lock that will unlock their potential to understand something. And you've got a lot of keys. So I think if you try as many keys as possible, you will unlock more locks. And especially with something like trading, where our language is um, binaural or diatonic. So it's very much yes or no. Our whole language is based on is it hot or cold? There is no in between. There it's but a mug. If it's got coffee in it, you know that the handle is colder than the rest of it. But there is no verbal explanation in any of the languages on Earth to describe that something is either hot or cold at the same time. And I think that's what trading is. That's what your trading approach is. The intuition, the subjectivity, and that requires a lot of explanation with our with our diatonic language, if that makes sense.
It does make a lot of sense. And yeah, dialectics are something that can, if you know how to use them, it's very beneficial. But if you don't, it just having dialectic conversations and using rhetoric to describe things, it fails to capture a lot of the granularity and the detail and the nuance to a lot of topics. So I'm with you. But okay, that's cool. That's good validation for me, feeling like I'm not wasting everyone's fucking time by explaining all these things. Okay, so up next we have Gianpiero Pascali.
Buongiorno, signore. Thank you, Nick.
Buongiorno.
Thank you for your time. Thank you for your insights. Now, I have a very basic question. I learned 10 years ago when I started trading, then I stopped and I started again. One motto is the trend is your friend until it bends. So if something is going high, you wait for a pullback and you buy. If something is going down, you wait for a pullback and you sell. You do the opposite. And you are very successful. But it's exactly the opposite as I learned. So I don't know if you can tell me how you came to this conclusion. Why do you do what you do instead to do what probably 80% of the traders are told to do?
Yeah, it's a good question, and I think this has more to do with the way that we think about concepts than it has to do with an actual trader's actions. So, upon close examination of the phrase "the trend is your friend," a person must be able to get a pretty precise definition of what they would call a trend. And trend is extremely subjective, and it's contingent on the amount of time that you go back to look on a chart, because you have to have context to identify a trend. If I ask you, what is the trend on the daily chart, but you're only allowed to look at the past 2 price candles, would you be able to identify the trend?
No, never.
Yeah. And so there's obviously more context to it than just looking at something. There's also quite the conundrum, and I guess the paradox, that price could be in a quote trend on one time frame, say a downtrend on the 1 minute, could be making lower lows and lower highs. But then whenever you switch to the 4 hour time frame, that downtrend on the 1 minute could just be a pullback of what appears to be an uptrend on the 4 hour. But then you yourself scroll out to the weekly chart and you find out that that quote uptrend on the 4 hour is actually just price moving towards the top of a bigger range on the weekly chart. And then you go to the monthly chart and you have no fucking clue whether or not there's a trend involved. So I think this whole idea of trade with the trend quote, I think it only really works if you look at assets that have been established as being in long-term trends for pretty much their whole existence. It works really well if you buy and hold the S&P 500. This has been an amazing strategy for the past few decades. Just buy the S&P 500 and hold, or the US 30, or the NASDAQ, or one of those things that are all in long-term trends. Whenever you start trying to apply that logic to something like forex trading, which you in almost all cases have to do with leverage because the percentage moves are so microscopic, it would be a nightmare to try to make any significant returns. without using any leverage at all. I mean, these things move sometimes like 0.5% per day. Like if you have $1 million and then this thing moves 0.5%, right? You make like 5K on $1 million. And catching 0.5% move in an asset is pretty amazing. So then you have to use leverage. And if you're using leverage, there becomes a question of, okay, I can't just buy and hold indefinitely. I need to sort of have an idea of what I'm going to do if it moves against me. And if you're in a trend, what is that? Do you put your stop just under the recent low that it just made? Do you wait for it to start looking like it's going to bounce and then go up? What if it has a deeper pullback and it's still in a trend? Okay, well, do you put your stop below the recent quote structure low? These are all questions that are extremely difficult to describe subjectively, which is why instead of myself, and me suggesting to others clinging to any type of logic that says only trade mean reversion, or only trade the trend, or only do X, or only do Y, or only do Z, what it does is it creates a type of mental barrier for you to be able to look at charts in a more creative way. And instead, a trader traps themselves into the illusion that there is any sort of predictability to the things that are happening on the charts, just specifically talking about technical analysis. Like support and resistance has a 50% success rate. If you buy at support and sell at resistance, it's 50-50. And the this is born of the fact that you could draw a support resistance zone anywhere. You could say that a moving average is pointing up or down depending on the time frame you're looking at anywhere. You could say that a trend direction is anything depending on the context and the surrounding price action. So my main rebuttal to this whole idea of why don't you trade with the trend, Nick, if that's the common logic, it depends on what time frame you're looking at. If you're looking at certain time frames, you could say Nick is trading with the trend. You could say Nick is trading towards the top of a range, or he's picking the reversal on where the new trend will begin, or he's doing this and that. I don't find it very helpful to say you're trading with the trend, or you're trading reversals, or you're trading ranges, or XYZ. What I find it more useful to say is I believe a trader should buy when they think price is going up, and they should sell when they think price is going down. Now, the reasoning, it's all subjective. It's all arbitrary. You can use so many different forms of mental gymnastics to convince yourself that one thing will happen over another. If you simply buy when you think it's going up, regardless of the quote trend that whatever, regardless of if it's in a range or at a support level or just broke a recent low, if you simply buy when you think it's going to go up and you sell when you think it's going to go down, and you have a defined risk structure and you have sort of a basic plan, if it goes against you, are you just going to let it hit the stop? If it goes against you, are you going to close half your position? If it goes against you, are you going to add to the losing trade? If you add to the losing trade, how much risk does that increase the total net outcome? Are you going to fuck with the stop loss and move it if you add in profit? By focusing more on the risk structure side of things and less on the mental gymnastics of whether or not something is in a quote trend, you avoid the trap of thinking that things can be quantifiably, objectively defined. And whenever you step away from that, it really allows you to start developing the skill set that is trading, which is using your discretion, instead of trying to stay trapped in the logic like everyone says buy during an uptrend and sell during a downtrend, but there's other people here that claim to not even look at the fucking trend, and they don't trade with the trend. This is a very big air quotes here. It can be so subjective that it is better to just not even look at it. Otherwise, you can scatter a lot of dust into your eyes by trying to go through all these mental labels of what you think something is or what you think it isn't. So I'd say to the cure for this, the antidote to get away from this type of black and white thinking is to just go to the chart, ask yourself if you think it's going to go up or down. If you think it's going to go up, buy. If you think it's going to go down, sell. And just make sure you're controlling risk. Put your stop where you think it's unlikely to hit. Set a target that you think is reasonable. Manage the trade as it's playing out. If you want to close early, close early. If it's drawdown, profit, break even, it doesn't matter. Buy when you think it's going to go up, sell when you think it's going to go down. Have a risk structure. That's all that matters. If you come to that conclusion by saying it's in a trend, okay, whatever. It doesn't really matter. If you come to the conclusion by saying it's a reversal trade, doesn't fucking matter. All that matters is buying when you think it's going to go up, selling when you think it's going to go down, and controlling risk. What do you think?
Yeah, I'm thinking about it. Yes, again, the fact that you are successful does play a huge role. I have to digest it. Thank you.
Herein lies the subjectivity of trading, my friends.
Yeah.
We have somebody named 2Ps here on the call. You may unmute yourself and let's chat.
Hey, Nick, how are you, sir?
I'm great, sir. How are you?
Can you hear me okay?
Yeah.
All right. Okay, question. If you were not trading this current style of trading, what trades would you do?
Try to repeat what you just said because your internet connection and microphone cut out. So just repeat what you just said.
Okay. If you were not trading mean reversion as you're trading now, what other trading strategy would you use?
That's kind of like saying, like, if you weren't married to your wife, what other woman would you be married to? It's kind of like it doesn't really what that would
Okay,
do.
I can ask it in a different way.
Try that.
I can ask in a different way. Um, if if my if my style is not to hold a trade for several days, if I don't want to do that approach, what other strategy would you recommend I do that is quicker? Maybe kind of like a get in and get out. Maybe the trade can last for a day instead of for several. What other strategy?
Well, what I'll do is I'll answer your question directly so that you have an answer, but then I'll get to what I think is the more important point, and then I'll talk about that. So the answer to your question of what do I do if I don't want to hold my trades for a quote long time? Well, you'll simply have to probably just use analysis that's based on lower time frames because since there is more data and more granularity in those time frames, the trade durations are typically much shorter, and your trade duration will probably be significantly shorter than if you're doing what I'm doing, which is trading on the daily and 4 hour and 1 hour. So the direct answer is to use lower time frames. Now, even though that's my response to you, I would question the reasons that you want to trade on a lower time frame. Here's all that really matters. When I hear people tell me, Nick, I know that you trade this way, XYZ, but I want to trade this other way, ABC. I want to trade with the trend. You're trading against the trend. So tell me, Nick, how do I trade with the trend? It's just an example. My question usually in response is like, okay, are you really after just trading with the trend like you say you are? Or are you really after just being profitable and making money consistently long term? What is it that you're after more? And so I pose this question to you. Are you really obsessed with trading lower time frames because you want shorter trade durations? Or is the actual goal, more importantly, to just be profitable at all, regardless of what the mechanics is? What is your answer to that?
Great, great question for me. Absolutely, it's about being profitable. Great answer to my question. Thank you.
Okay, sweet. Well, that was simple enough, so we don't even have to
Yep.
continue. So, yeah, I would pose the question to any of you who, when you look at the way that someone trades and you see it's working for them, understand that you're never going to be able to mimic or duplicate exactly what another person's doing. But it's more important to ask yourself if you feel like, no, I could never trade futures. They move too fast, so I have to trade forex. You have to ask yourself, like, the difference between you and the true outcome you want, which is profitability in any market, doing whatever the fuck it takes to be profitable. The difference between where you're at now and getting there is your set of decisions. And all that really matters is that you are making decisions that actually result in you being profitable. I would be very baffled if we took a poll here on this call and people said that they were more concerned with the way they traded, like the methodology, as compared to if they're just profitable at all. Like if I told you guys, okay, here's how we're going to trade going forward. I found a strategy that has a 99% win rate, and I do this, this, and this, and all we have to do is just that, and it's somewhat specific and somewhat easy to learn. We could probably this could be analogous to what I'm doing right now. If we found a way, and then you guys knew that that would be profitable, very little of you would give a fuck as to what the actual mechanics were. All you'd be thinking is, I know that if I just do XYZ, then I'm probably going to be profitable and this works. It doesn't matter why it works. It doesn't matter how it works. It doesn't matter what the mechanics are, the details are. All that matters is that it is profitable. Now, whenever you evolve into a trader that's profitable, you will have your own specific approach that works for just you, and it will be unidentical to anyone else ever. It'll be very nuanced. That's the whole concept of manual trading. It will revolve around your skill set and your brain and your experience. Very few of you would give a shit how that actually plays out. If it happens to be like our friend Double P here, if it happens to be on lower time frames and your trade duration is like a day or two, that's fine. That works. There's nothing wrong with that. If it happens to be on the larger time frames and you're more along the lines of like me, which right now I average about one trade per week, then that will be the case. Most of you, what you're really concerned about is you're concerned about just being profitable, making a profit long term. I would focus on doing whatever it is that looks like it's getting you closer to doing that. This is just simply just getting data and experience and doing more of what works and less of what doesn't over time. I would focus more on around that process. And if I were you, I would just completely abandon any sort of mental proclivity to try to seek out trading a specific way, because none of that makes sense whenever your end goal is just profitable trading. You're essentially inserting a proxy or a barrier in between you and the outcome by saying, yeah, I want that outcome, but I want to do it this way. If you want the outcome, and there's a bunch of ways that could get you there, and they're all legal, and you're not hurting anyone, then why not just take whichever way appears to be the easiest? Why insert some sort of arbitrary thing like, I'm only going to trade with the trend, or I'm only going to trade on lower time frames, I'm only going to do this and that? I would say just get experience, find what seems to work best for you. This generally takes around 6 to 12 months, and then just do whatever fucking works best, because really you're not going to give a shit how you do it. What you will only care about is that you're able to do it. Let that process play out by getting experience. Before we switch to the next question, Double P, do you have anything you want to add to that or nothing?
No, that's it. Thank you so much.
No problem, man. It's a good question. It was good to touch on those. So up next we have Space Monkey.
Hey Nick. My question is, does price have to only go down like 50% or 30% in order for it to continue upwards? Or does it, like, let's say Bitcoin, it made that, let's just say 2021, it made like I don't know, a top, and then it went back to pretty much where it, yeah, let's just say 18K. So does all charts have to eventually like go back to where it entered, where it didn't have any major pullbacks, or if that makes sense? It doesn't have to be Bitcoin, it could be anything. It's just like I see it never actually hit like 10K or 12K where it actually started to go up, if that makes sense. Like does the price can continue go up without actually retracing all the way down to where it actually started going up, if that makes sense?
Yeah, it's a good question. So the answer is yes. Price can continue going in one direction and never pull back. So
like, yeah.
I'll keep this short. That way you can continue and don't lose your train of thought. Because of this, because there are cases where price doesn't pull back and doesn't have quote unquote mean reversion tendencies, this is why I don't try to sell like the S&P 500. This is why I don't try to sell a crypto altcoin during a fucking bull run, because of that exact concept. So then I'll stop there and then allow you to continue.
Yeah, I'm just curious, like for percent wise, why is it always like it's never like it's always 30 to 50% of the retracement of like if it goes one way. Like it's never always like more than 100, if that makes sense. Like
What you're doing is you're just characterizing the degree of momentum that a trend has. So you might say if price goes up and then has a pullback that is about 70% of the previous move up. For
yeah,
those of you who are not familiar with this concept, if we call the origination point from where price goes and it makes a higher high, if we call this 100%, we look at the pullback and we ask, what percentage did this pullback of the previous, this is called an impulse. So for this retracement is what it's called, what percentage of the impulse is it? This would be about 70%. So we go, we have another impulse, make a higher high. And then in this case, we pull back, let's say 70%. And then let's say this does that, right? We would characterize this as just a trend. Now, what kind of trend? To be able to characterize those, you have to look at other types of trends to be able to characterize that. There are the types of trends which occur on crypto altcoins that are micro caps during bull runs where it does this impulse, a pullback of maybe like 5%, 10%, then it rockets up, and then a pullback like this, maybe a temporary dip, and then just rockets up, and then shit like this. So if we were to characterize, meaning we're just comparing and contrasting these two, which one would you call a stronger uptrend, Space Monkey?
it's probably the first one.
Hmm.
What do you mean stronger? Like it's I think it's more stable, the first one, and probably the second one's more stronger.
Hmm. So I guess stronger isn't the right word. Which one would you characterize as having more bullish momentum?
It's the second one.
Okay, so then it was an error in the way that I asked the question. So that's the point I was trying to dictate. Now, if you're saying this is more predictable, I 100% fucking agree with you. I love when shit like this is happening. This is why I'm short on CHF JPY right now, because this has happened. When it's this predictable, it's great. There's a good tendency for price to, quote, mean revert and pull back. So using the word stronger might be misleading. That's not what I meant. This is a more predictable uptrend, in my opinion. But what I meant is which one is stronger in terms of momentum. Something like this would be the case. Now, why is it the case? It's the case because whenever you see big pullbacks, I'm sorry, huge, big impulses followed by zero pullbacks or very small pullbacks, like where it barely pulls back 5 to 10% of the previous impulse. What this means is that there are tons of people buying, and then almost no one sells, and then tons of people buy again, and then almost no one sells, because if they were selling, you would have a fucking pullback, right? But if that doesn't happen, it just means almost no one's selling. Then it has another huge impulse upwards, and it is just a back-to-back stampede to the upside. And so whenever it comes to something like this, you end up finding that trends like these occur in certain assets, and then trends like these right here occur in other assets, like, for example, the forex market. I'll give you two examples, and then we can talk about it more if you want. When we go to a monthly chart on Bitcoin, and then we switch it to logarithmic to account for the percentage increases, you will see that every time in Bitcoin's history for the past, let's say 12 years, price has gone up, barely pulled back, went up huge in terms of percentages, barely pulled back, went up, pulled back barely, and then went up, and then all this stuff. So it's just this up and down thing. Would it be smart, and this is a question to you, Space Monkey,
Yeah.
would it be smart to sell Bitcoin thinking that it might pull back all the way right back to here?
It could
So,
because
so it could, but the question is, would it be smart to sell thinking that Bitcoin will be likely to go all the way back to here?
yeah, probably not.
Probably not. And what is your reason for thinking that?
Because it's just demand and supply. It's going to continue to go up. So I kind of fundamentally it's going to go up anyways.
So
Uh,
fundamentally, yes, you are correct. It's supply and demand. You know, supply gets smaller, demand gets higher, price goods go up. But even if you're not looking at fundamentals at all, when you're looking at just the candlesticks on the bear chart, right? When price goes up and then it barely has a pullback, then it goes up more and then barely has a pullback, and then more and barely has a pullback. It's just not the most intelligent thing to do to quote fight the long-term trend, which is why it would be a silly thing to sell this here.
so I always thought like retracement is always for like in order to make the price stable, if that makes sense. Like, so it seems like it's fair value. That's why I always think that's what retracement is for. Am I wrong or
What you so it's not that you're wrong. It's just that the way in which you're conceptualizing it mentally does not track onto reality for all assets. So what this means is that, sure, there are times where a price goes up and then it has a really big, nice pullback. This is why I love the forex market, because it has nice mean reversion tendencies. You typically don't see many assets continue to stampede in one direction over the other with no reversion or no characteristics of that at all. It's what I call a steady state market. What that means is we have nice moves in one direction, generally followed by nice moves and pullbacks in the other direction in general for most of the currency pairs. This logic does not apply whenever you move into a market like Bitcoin, like I just showed you, and a market like the S&P 500, which for decades has just gone in one move. So if you were to apply your logic to the S&P 500, um, this is this is going back into like the 70s, the 60s and 70s.
Hmm.
The only times you see strong pullbacks are like anomalies. So stuff like this right here, where this was literally the market crash of 2008. This right here was the pandemic crash um, back in 2020. Um, aside from that, you don't really see this idea that you've described and conceptualized in your brain, which is price needs to quote pull back to be able to have fair value, so that way it's more steady, and all of these things that you tell yourself. Sure, that maybe applies, that framework applies in FX, but probably not here on the S&P 500, because this shit really does nothing except go straight up for decades. So it wouldn't be good to exercise that logic there. However, if you apply that to FX, then I have no problem with that. Yeah.
Okay, so with FX, does it need to be like somewhat symmetrical, or is that just your head playing games? Like like even or like mirror image kind of thing, or is that not really when it
So I
comes to FX?
Yeah, so I can't say I 100% understand exactly what you mean by symmetrical, but based on my basic understanding of what you're actually trying to convey and what you're trying to ask, I would opt to say I'm 99% sure that it's probably I'm sorry, it's probably your brain just playing mental gymnastics on you and trying to rationalize and justify things on the chart that ultimately might not actually be beneficial at all to your trading and might have no predictive benefit.
All right, sweet. Thanks, Nick.
Yeah, no problem. Good questions and good conversation.
Thanks.
All right, my friends, it has been an amazing live session so far. I will take, so I don't want to put a limit on how many more questions, but what I'll say is I will wait here for another 30 seconds. And if any of you would like to chat with me or ask a question, I will wait for you to click the Zoom option to raise your hand, and I will call on you, and we will have a nice little chat. So I will wait. Go for it, man. I can't hear you. Your microphone is not muted. However, it's not coming through.
How about this?
No, no, you mean
Yeah, I'm
dickhead,
just
yeah.
fucking. What's up?
No, it's I think the conversation that you and Space Monkey just had, I know you're not an indices guy, Nick, but hopefully this will be okay for Space Monkey in like a real life example of it. So I'm watching the Nasdaq on the 4 hour chart at the moment, and I think if you look from the middle of April up until where it is now, you've got quite, I feel, some really good examples of both of the sort of phenomena, I guess, that you explained. Where if you look from the middle of April, new highs, some quite good pullbacks. And then if you look at where it started in June, it's very powerful, very, in my opinion, quite impulsive and unsustainable. With the short bursts up, consolidating or moving sideways for a period of a couple of days and doing that several times over. And it now looks as though what I would call an unsustainable upwards move is now beginning to pull back. So I'm long term bullish on the Nasdaq, as I feel everybody should be, but I'm looking for price to come back up a little bit more before I take a short because I feel that it's overdue a more substantial pullback because of the massive, great big up move it's just had on the 4 hour. So that's me just sharing my thought. It wasn't really a question, but for Space Monkey, if you want to see I suppose, a real world example of what Nick was just describing, I think the Nasdaq at the minute on the 4 hour is a really good one.
Space Monkey, what say you to that?
Yeah, I actually know someone who's shorted it from the top, but yeah, I agree. It's just, yeah, I'm not actually disagreeing, so
No,
I
that's
agree.
fine. It was just in case you wanted to see a. It's I think at least myself, I've always a lot of the time when people draw on charts, it can always be an idealized example, but I just think in this particular instance, it may have helped just to see a real world example, and that if you fancy playing around with an index, you might actually be able to leverage that and make some profits on this one. I'm fucking hoping to anyway.
Sweet.
All right, cool. So up next we have I saw Rob, but he put his hand down probably to give the option for the other people. So we'll start with Dre then.
Hey, bro. Last session you mentioned something about changes in the group, but I just got the tail end of it. Do you mind explaining that again?
Yeah, so the group we're gonna make the price for people who want to stay in close friends. It'll be $250,000 per month, and that'll only be for the first month, and then every month after it'll only be $125,000 per month. So we're giving you guys a little bit of a discount.
Cheap as fuck.
Yeah, it's actually a steal, quite literally, but not for you. So no, we here's what I'll say. We don't have any formal announcements for it. As you know, compounding course clients access expire at the end of this month for access to close friends, and full program clients access expire for close friends at the end of this year. We don't know what we're going to do with the final outcome for full program clients. We don't know if we're going to move them back to the original group chat and start using that one, or if we're going to keep the close friends group chat for full program clients. We also don't know if we're going to continue forward with close friends as a product. It's a product that I spend 90% of my time helping people with, and you guys love it. You guys get the better end of the deal, but it represents less than 10% of the profits from Mission FX. The most profitable thing, whether you say this is unfortunate or not, the most profitable thing and the most popular product that most people seem to want is the Nick's Trades group. It's quite baffling to me. Most people just want to follow trades, and they don't appear to care that much about Zoom sessions like these, or one-on-one help in the group chat, or being in a community with other people, or any of that. Most people seem to just want to be able to follow my trades live, and that's it. So that's probably going to be the thing we focus on going into 2025. However, I don't know exactly what our plan is to sort of tie things up with the way things are right now. whatever it is, we'll make sure to do what's in the best interest of our clients, as we always have done for the past 6 years, as long as that also aligns with what our objective is as a company. We'll make sure that everything aligns and there won't be anything that's like rash or sort of arbitrary or unjustified. Those two things have to be like a win-win. It has to be not only good for the customers, but it has to be good for the company as well. If one of those things is not true, then there's misaligned incentives. We're doing things that are better for the customer, but then at the cost of the company and our resources and allocation of time. And then if we do what's best for the company, but what's not best for the customer, that still doesn't work, because then we won't have customers for very long. So it'll be aligned and everything will be good long term. I hope that answers your question.
That does. Thank you. Good luck trying to figure it out.
Yeah, thanks, bro. Yeah, we've always figured shit out like this before. It's always ended up really good. We've had clients in Mission Effects since like 2018 and 2019 that are still in the group chat. It's fucking crazy. So yeah. So we've got next up, we've got Alsaf. And I hope I've said your name right. Correct me on how to say your name. Alsaf.
Yes, hello everyone. Can you hear me, Nick?
Yeah. How do I say your name?
Osaf.
Osaf. Okay.
Yes.
Sweet.
So I just want to start off by saying that this is my first month in the group, and I've been following everything in the group since I joined. And forgive me if this has been asked before, but um, what is your take on trading indices on NAS 100 and US 30? Because I was looking at the channel. I've been following your channel for quite a while, probably 6, 7 months now. But I haven't noticed too many videos, or I don't think so. There is a video on NAS 100 or trading indices. I just wanted to know your take on that. Thank you.
Yeah, so I guess two things here. First, I don't personally trade indices, but there's no specific reason. It'd be like Duncan here who trades soybeans asking me, "Hey Nick, why don't you trade soybeans?" It's like, well, I don't know. I just never got into trading soybeans, I suppose. For me, I've been trading forex for quite a long time. Like it's how I started my journey 8 years ago. And then I also dabble in stocks, most of it long-term holdings in indices, and then also cryptocurrency, most of it being long-term holdings in Bitcoin. But my active trading, I just feel like I have the most experience in Forex, and it's always been my bread and butter, and I've always done pretty well in it. And I continue to do a little bit better each year trading Forex, with the exception of last year, where I made less last year than I did in 2022. But, we'll just, not talk about that. So Forex has been my bread and butter, and indices I just never got into. However, I don't have a particular reason. So that's the first answer, is that I don't trade indices. That's why I don't have videos about it or anything. The second thing I want to highlight that I think is more important is that I want to say very clearly, it doesn't matter what asset a person trades. If they want to trade futures, if they want to trade commodities, like the fucking cocoa chart that Duncan got long on or some shit that ended up rocketing up. If you want to trade cocoa beans or soybeans or, whatever, corn, it's cool. Like everything can work provided it's in the right context and you get enough experience trading that market. If you find yourself wanting to trade indices versus, say, for example, Forex, then trade indices. There's nothing wrong with it. The same concepts apply. Maybe like, we'll say 90% of the concepts can be tracked onto most markets. You're still going to have to learn price action and get experience seeing something. You're still going to have to control risk and define how much you're risking so that way you don't lose all your fucking trading capital. A lot of the same mechanics and concepts still apply, but the 10% difference lies in the nuance, such as like if you're looking to sell the NASDAQ index and hold that trade for months, thinking there's going to be a big move down, that almost never happens in NASDAQ. So it might be a stupid, dumbass thing to do. So that might be one of the nuances within the 10% of things that are not analogous to other assets that you could trade. So if you, for some reason, feel like you have a better reason for trading indices above something like, say, Forex, then please go and do that. Whatever you do, what will matter is that you get enough experience in that particular market to then justify being able to use your discretion to make trading decisions. And it doesn't really matter whether it's Forex, futures, indices, stock, crypto. or fucking soybeans, Duncan. Let me know what you think about that, Osaf.
Also, I have another question, if you don't mind.
Yeah, what's up?
So for all, so for every single forex pair that you trade, generally speaking, all forex pairs, they don't move exactly the same. Some are more volatile, some are less volatile. Um, GBP USD is, has uh, different level of volatility compared to, say, AUD USD. How do you mitigate and how do you, let's say, understand how each and every uh, or not each and every, but let's say a few forex pairs trade when you trade so many forex pairs all together? Because I see that you sometimes you just scroll through a random forex uh, pair and then you select it and you just track it for quite a while until you take a trade or until you don't take a trade depending on your subjective reasoning. That's
I'm trying to filter your question from that. So I think your question might be, and you'll be able to correct me if I'm wrong, is you're asking, how do I control risk even with the fact that forex currency pairs move at different quote speeds?
Yes, a different. I mean, not every uh, forex pair is similar to another. Although there's all there, of course, you apply the same rules such as support and resistance, and you apply the same rules to them. But sometimes they move differently than other forex pairs. They're more volatile, and they don't have as much volume. For example, Euro USD has a lot more volume and it's traded a lot more than other forex pairs. So it has a different level of movement and volatility compared to other forex pairs. So when you go to trade, when you're trading in the forex pairs, which are say not the U.S. dollar. I'm forgetting the term that they use for the big four forex pairs. But when you're trading more volatile forex pairs, how do you mitigate the risk and how do you understand how they move?
Well, for one, it would just be experience, like noticing, hey, Euro USD has, let's say, more trending movements, more momentum as compared to something like Euro CHF, which can go sideways for fucking ever, or CAD CHF, even worse. So, yes, there's merit to what you're saying. Different assets move differently. That's like saying, like, every cat's fur might have a slightly different pattern if it's like a calico cat or something. So yeah, different pairs are different. Now, I think what's more important, what's kind of the most significant part we should touch on here is you're like, how do you control risk? How do you account for that in the risk of the trade, like for different quote different amounts of volatility? And here's how I do it. It's a very simple answer. It's not a sexy answer, but it's very simple. I just calculate the lot size for each pair depending on the context. If I'm selling Euro USD and I think, okay, if price moves up against me to here, then I'm going to put my stop loss there. I'll look at how many pips that is. If it happens to be 200 pips, then I'll calculate my lot size based off that, risking no more than whatever it is I'm comfortable risking from the entry to the invalidation, 30K, 40K, 50K, or more. If I go to a pair like I am on right now, CHF JPY, the invalidation for this pair is, don't quote me, but it's like 400, 500 pips, maybe more, right? So this is like 400 pips versus 200 pips is significant. If I was entering Euro USD with like 10 standard lots, and that was a 30K risk with a 200 pip invalidation, if I'm doing that for CHF JPY, but the invalidation in terms of pips is double, then I might have to use roughly half the lot size of what I used on Euro USD. But all of this is accounted for, provided that a trader just calculates their risk before entering the trade. You don't have to even know what the volatility of the pair is because that will be factored in to your risk structure whenever you go to calculate the lot size. When you go to calculate a lot size on a trade that has an invalidation or stop loss area of like 500 pips, you're probably going to be using a significantly smaller lot size. That's what it will come out to be, as compared to if you're entering a trade with, say, only a 100 pip invalidation. You'll probably have to use a heavier lot size on that to account for being able to risk the dollar amount you want to risk. So that is my answer as to how to account for the risk, even though different currency pairs move at different speeds. I would never, well, let's never say never, but I would not, in 99.99% of scenarios, just use the same lot size for every trade. That'd be like saying, I'm going to sell Euro GBP, which can sometimes have invalidations as small as like 30 pips because it barely moves. I'm going to sell with the 10 lot, but then I'm also going to go to CHF JPY and sell with the 10 lot. CHF JPY is going to wreck you so much quicker if it moves even to the slightest amount of drawdown because of how fast it moves. The pip movement is just much more volatile. Euro GBP, you would be falling asleep like trading with 10 lots because it just barely moves. So I hope this shows the distinction and the contrast between how I manage those things and how they all work together. What do you think?
Yeah, thank you very much. That answered my question.
Okay, perfect. Yeah.
Also, just a side note, I mean, I feel quite connected to you because I'm also Indian. I remember you mentioning that you're half Indian, so props.
Yeah, yeah, bro. We're from I'm gonna, if trading doesn't work out, I'm gonna go to Bollywood and be a comedian. Okay, guys. Well, that sums up the live session for today. It was a really nice live session. This recording will be uploaded and I will share the link with you all. I appreciate all of y'all's participation. I appreciate the questions and thank you guys for everything. I'll see you in the next one.
See you guys.
Good day, guys.
See ya.
Bye.
See ya.